Say you've come into some money. Maybe it's a work bonus. Maybe you've been saving diligently for a couple of years, or maybe it's an inheritance. Either way, you've got a meaningful sum sitting in your bank account. Let's say £20,000, and you've decided you want to invest it for the long term. Well, here's where it gets interesting, because now you face a question that even experienced investors debate. Do you put the whole lot in at once, or do you spread it out over time, dripping into the market gradually month by month? Well, that sounds like a simple question, but it isn't. And getting it wrong or not thinking it through could affect how comfortable you feel with your investments and potentially how they perform over time. Hello, I'm Brian, and today with Moneyfarm, we're going to examine both approaches to see if one really is better than the other. Let's dive in. Let's start with lump sum investing, because in many ways it's the more straightforward of the two approaches. Lump sum investing simply means taking your available money and putting all of it into the market at once. And the core argument in its favour comes down to one idea: time in the market. Now, as we talked about in the video that you can find on this channel, when you invest, you're putting your money to work, which means that the longer it's working, well, the more opportunity it has to grow. But here's the thing, it's not just about growth in a straight line. The longer your money stays invested, the more it benefits from something called compounding, where the returns your investment start generating returns of their own. Now, compounding is a super interesting phenomenon that you barely notice over a short period, but it can be transformative over decades. So the logic of lump sum investing is simple. Get your money into the market as soon as possible and let time and compounding do the heavy lifting. And those who advocate for lump sum investing don't stop there. They also point out what happens to the money that isn't yet invested. In fact, if you choose to invest that £20,000 gradually, say £2,000 a month over 10 months, then after month one, £18,000 is still sitting in cash, and after month two, £16,000 is still sitting, which means that all that money isn't working for you, isn't compounding, and depending on the economic environment, it may even be quietly losing value to inflation. And this is why you'll often hear the phrase, it's time in the market, not time in the market that counts. And it turns out the data backs this up. Research comparing lump sum investing to gradual investing across different markets and time periods has consistently found that lump sum investing outperforms the majority of the time, precisely because more money is invested earlier and has longer to grow. But if lump sum investing tends to win on the numbers, then why doesn't everyone just do it? Well, the reason is that investing isn't purely about numbers. It's also about emotions. Let's run through a quite common scenario together to get the point. Now, say you commit your £20,000 to the market, and then a few weeks later, markets drop because something that happened somewhere around the world, and suddenly your £20,000 is worth only £15,000. Now, rationally, you know this is part of investing, and you know that markets go up as well as they go down. You also know that markets have historically recovered over time, and that if you stay the course, you're likely to be fine. But here's the thing, knowing something rationally and feeling it emotionally are two very different things. And watching a significant sum of money shrink shortly after you've invested is generally uncomfortable. And for some people, that discomfort is enough to make them sell, locking in their losses at exactly the wrong moment. Well, to tell you the truth, this is not a hypothetical scenario, because history is full of examples just like this. Now, think about those who invested right before the dot-com bubble burst in 2000, or just ahead of the financial crisis in 2008, or just before the COVID crash in 2020. All those people faced years of paper losses before markets recovered, and those who panicked and sold didn't see their losses reversed. But what does this tell us? Well, it tells us that the catch with lump sum investing isn't really about the strategy. It's about whether you have the temperament to stick with it when things get rocky. Now, all this brings us to the alternative to lump sum investing, which is phasing your money into the market gradually over time. In the UK, this is known as pound cost averaging, or dollar cost averaging in the US. And the idea is straightforward. Instead of investing everything at once, you invest equal amounts at regular intervals. Say £2,000 a month for 10 months, just to get back to the previous example. Now, because you're investing the same fixed amount each month, the number of investments you're actually buying will vary depending on what markets are doing at that particular moment. When markets are higher, your £2,000 buys fewer investments, and when markets are lower, your £2,000 buys more. And over time, these fluctuations average out, which means you're never fully exposed to a market peak at the moment you invest. Now, does this mean that pound cost averaging outperforms lump sum investing? Well, usually no, and it's important to be straight about that. The reason, as we mentioned before, is that with pound cost averaging, you're keeping money in cash for longer, and you're potentially missing out on the gains during the months when that money isn't yet invested. On the other hand, however, pound cost averaging does one thing very well. It reduces the emotional risk of investing, as you're never putting everything on the line in a single moment. Let's think about it. If markets drop the week after you invest, you've only committed a portion of your money, and the next installment actually benefits from lower prices. In other words, that steadier, more gradual entry into the market can make a real psychological difference, especially for people who are newer to investing or who find market volatility particularly unsettling. Effectively, it allows you to steer away from making what can be a tricky choice of when to add the funds, which can often be prey to one's emotional biases. When you have money drip feeding into the account on a monthly basis on a certain date, this can provide better peace of mind for some investors and accommodate a good habit of investing regularly. And when you're investing money that matters, like life savings, a future house deposit, or a retirement pot, being able to stay the course is every bit as important as the strategy you choose, which means that an approach you stick with through turbulent markets will almost certainly beat a theoretically superior approach you abandon when things get a bit difficult. Now, there's a third scenario worth addressing directly because it applies to a lot of people. What if you don't have a lump sum sitting there and ready to be invested? What if you're simply building your wealth steadily, month by month, from your salary? Well, in that case, the lump sum versus pound cost averaging debate doesn't really apply to you because your only option is to actually invest what you can month by month. And regardless of the best theoretical approach, investing consistently and regularly is one of the most effective ways to build long-term wealth. Not because it's mathematically perfect, but because it's sustainable and it turns investing into a habit rather than a decision, which means you're less likely to second guess yourself, less likely to try and time the market, and more likely to stay invested through the periods that matter most. The key principle is the same regardless of approach. Keep investing, stay invested, and give time and compounding the chance to do their work. So, should I choose lump sum investing or pound cost averaging? Well, here's the honest answer. For most people, it comes down to two things. First, how confident are you in your financial stability right now? If you have a solid emergency fund in place, stable income, and no major expenses on the horizon, investing a lump sum immediately is a perfectly rational choice, as your money gets to work faster and the long-term case is strong. But if committing everything at once feels generally stressful and you'd be watching the markets obsessively and would struggle to sit tight during a downturn, then pound cost averaging is not the inferior option. It's the smarter option for you because it's the one you'll actually stick with. Second, think about the size of the sum relative to your overall financial picture. A £5,000 lump sum may feel very different from a £50,000 one. The larger the amount, the more the psychological dimension of the decision tends to matter. And most importantly, bear in mind that there's no universally correct answer here. What matters is that you make a deliberate choice based on your own circumstances and that you commit to it, rather than hovering on the sidelines waiting for the perfect moment to invest, which, as any investor will tell you, never quite arrives. So whether you've decided to invest a lump sum, phase your money in gradually, or start building wealth monthly from your income, the practical next step is the same. Find a platform that makes it straightforward. With Moneyfarm, you can open a stocks and shares ISA online and choose how you want to invest, picking your own funds or opt in for a professionally managed portfolio matched to your goals and risk profile. And whether you want to invest a lump sum, set up a monthly contribution, or do both, the platform is built to make that easy. The most important step, as always, is simply to start. And if you want to learn more about Moneyfarm, you can find links in the description below. And there you have it, everything you need to understand about lump sum versus pound cost averaging. I hope you enjoyed this video. If you did, please subscribe to the channel. And if you have any questions, feel free to drop a comment. And as always, see you in the next video. Bye-bye for now.